Hey, how are you doing? The name is Roger Gitonga. I'll be taking you through chapter 10, identifying and preventing fraud. Okay, so this is a very key chapter because fraud is actually quite rampant right now in many companies, and you'd find that it is a key issue, it's a key practical issue that we're actually battling in the business world. And hence, I would really recommend that you would be able to be very sharp in this chapter because it will most likely be tested in your exam. Now, the first thing we're going to be tackling is what is fraud? Now, fraud is a false representation of fact made with the knowledge of its falsity. Now, before I get into the two main categories, I want us to understand that with fraud, first and foremost, it is false representation, meaning you're lying. And two, you know that you're lying. So when you're trying to hide something from someone and you know that you're doing something wrong, then that would be defined as fraud in the context of business and accounting. Now, the two main categories of fraud are first and foremost the removal of funds or assets from a business, and two, intentional misrepresentation of the financial position of the business. Now, we're going to be going through these two main categories in our next slides. Now, the removal of funds or business from a business. One of the first things that we're going to see under this is that there is actually a theft of cash and inventory. When you steal money and when you steal inventory, then you're basically removing assets from the business. To payroll fraud. And what happens here is that you find most people have maybe left the company, or some have passed on, and you did not close their accounts in the company. So you'd find that someone would be paying still into those accounts, but in real sense they are putting that money for themselves, right? So that's the payroll fraud. Now, teaming and lading, I want us to imagine this before we go through the whole context. Okay, we have three different people. Okay, we have Tom, we have John, and we have Mary. Okay, Tom, John, and Mary. Now, let's say that Tom, John, and Mary owe the company I work for, okay, some money because we had been supplying to them, but they did not pay us back because maybe we lent them the goods on credit. So Tom owes me around 10,000. And what happens is that when Tom pays me that money, instead of clearing his balance, I put that money for myself. Now, when the next person who owes us, which is John, pays us, what I will do is that I will use the money that John used, okay, or the money that John paid us to clear the balance of Tom. So what are you trying to do here? You realize that now Tom's balance is cleared, but John still has a balance with us, right? But in actual sense, it's actually paid. And then when Mary pays, I will use Mary's payment to cover the previous customer's payment balance, and I'll be left with Mary owing us money. So how will this will continuously happen. I'll continuously be using other customers' receipts to clear others' balances. Now, if when I leave, the next person who comes in will then alert one of the customers and say, hey, you have a balance with us. But that customer will say, but I paid it. And what will happen is that they will realize that I disappeared with someone's money. And before they find the culprit, the person is already gone. Right? So that's how teaming and lading tends to work. So we say it is the theft of cash or check receipts. Now, the one who receives cash to settle a payment will not deposit the cash, but will use it for his personal use. When another payment comes, he will deposit that cash against the first cash used and does not show the new amount received, and the process continues. Then we'll also be supplying to fictitious customers, which is a way of stealing inventory. You're not really supplying to anyone. You just find yourself maybe supplying it to yourself, but you're saying you're supplying it to customer A or B. Then the second category, intentional misrepresentation of the financial position of a business. Now here we'll see overvaluation of inventory. Now this can be done when you omit delivery records or goods return records. So you show like you have too much than you actually do have, okay? Two is fictitious sales or false sales. You show that you've made sales to certain people or customers, but in real sense you have not. And this tends to really misrepresent the financial position of a business. 3 is understating expenses by failing to record all expenses accurately, which will ideally lead to a high profit figure. So it tends to deceive quite a number of stakeholders that you're doing well, but in real sense, you're not. Now, potential for fraud. What would encourage you to commit fraud? Now, there are 3 conditions that we'll be looking at, okay? The first one is you're just dishonest. So if you're dishonest, then you will commit fraud. 2, motivation. Now, motivation comes here in the sense that maybe I've been seeing on social media, you might be challenged and told, tag a friend who you'd want to live in this island with, or tag a friend who you think will be a billionaire or a millionaire in the next 5 years. And what happens is that you tag your friends with no ill intention, but just to wish them good luck. But what happens is that you would also desire to live a flashy lifestyle. And what happens is that if you do not have the money to live the life that you want to live, you might be motivated to actually commit fraud. 3, opportunity. Once you discover that there are loopholes or there is a hole in which you can get in and get out without being noticed, then you will ideally take up that opportunity unless you are honest, right? Now, which systems for detecting and preventing fraud will we be looking at? The first one is just lock the tangible assets. Things that you can touch, lock them, okay? 2, segregate or separate duties. Just separate duties, because giving one person so much power is so dangerous, okay? They can do so much with that power and be able to commit fraud without even the company noticing. 3, customer signatures. I know for a fact that when we order something from abroad or maybe from online stores, then what would happen here is that once the goods have come, they would require your signature just to show that you've received that good, and that really helps a lot with trying to prevent and detect fraud. 4, using words rather than numbers, since it is more difficult to change text than to alter a figure. I can write on a check that I want to pay someone $10,000, but the person who receives the check might add another 0 to the number, and it will read $100,000. But you'll find that when the bank receives the check, then they will rather look at the words rather than the numbers, because with the words I've written 10,000, it will be very hard to change a 10 into a 100,000 statement, isn't it? 5, enforce a holiday policy. Tell your staff to go, because even a 2-week absence is sufficient time for a fraud to come to light. Remember this, their presence there means that they can be able to control anyone from seeing the fraud that they are doing. Okay, but if they go, they're not able to do that, and hence some of these things that are happening in the darkness tend to come to light. Now, the next one is whistleblowing, which is basically exposing or speaking of something that is not right, that you know of or have seen or detected in the organization. You know that this is wrong, so you end up, we used to say it back in school, you're telling on them, to the teacher. So basically here you're telling on them to the authorities, right, that they are doing something wrong. Now, who is responsible for detecting and preventing fraud? This is very important. It is the responsibility of the directors. It is not the responsibility of the auditors, okay? It is the responsibility of the directors, because they are the ones who had set the internal controls. They set those internal controls with the main aim of trying to detect, to prevent, and to correct any fraud or error from occurring. So it is their responsibility to ideally detect and prevent it. The external auditor should only express an opinion on whether the financial statements give a true and fair view of the company's financial situation and results. Money laundering. Now, before I come to the definition of money laundering, we just basically mean it's trying to make dirty money clean, because laundry is cleaning. And money, if you're trying to clean money, then that means it's dirty. So you're just trying to make dirty money clean. But with more technical terms, this means that this constitutes any financial transactions whose purpose is to conceal the origins of the proceeds of criminal activity. So some money has been made through criminal activity, and you're trying to hide okay, the source of your money, because if people detect the source, then they might detect the criminal activity that you are doing. Now, the process includes placement, which is the initial disposal of the proceeds of the illegal activity into apparently legitimate business activity or property. I remember there's some few people from some other from some developed country that were trying to hide their process because they had been selling illegal stuff. So what they did was that they invested highly and heavily in Africa, in different land, properties, houses, and the likes. That way they're able to hide their source of income. Two, layering. Now, the word layering, imagine when you assume a layer just means from one side to the other, from one side to the other. So you're trying to transfer monies from one business to the other, from one place to the other. So it keeps on hopping from business to business. You ideally hide the original source. Three is to integrate. When I think of integration, I think of blending, like a chameleon. You try to blend with your environment. So this is basically means that having been layered, the money now has the appearance of legitimate or legal funds. E.g., when you gamble that illegitimate or illegal money, you receive the winnings and then deposit the money in the bank as gambling proceeds or sales, and hence you've hid the source of money. Now, categories of criminal offense. The first one is laundering, which is basically acquiring, possessing, or using proceeds of criminal conduct or assisting another to retain the proceeds of criminal conduct and trying to hide or to conceal or try to convert or transfer or remove criminal property. So you're just trying to hide the source of that income. Now, also failing to report. If you know that something is wrong and you do not if you do not report, then you're basically also committing an offense. Three is also tipping off. Okay. Thank you very much for listening to me. I hope you learned quite a lot, and I also hope that you'll do well in your F1 exam. All the best.